Okay, guys, it's time to come back. It's my pleasure to introduce the author and the presenter of the third paper today. The third paper is about what should investors care about, mutual fund rating by analysts versus machine learning techniques. Chen Si is from Chinese University of Hong Kong. And it's also my pleasure to introduce Richard Crowley, who will be the discussant of the paper. Richard Crowley is a professor from Singapore Management University. Okay, Chen Si, you have 25 minutes.
Sure, thanks. So first, I would like to thank the conference organizer for including the paper in the program. And this is a joint work with Ruichang Lu and Xiaojun Zhang from Peking University. So I guess I don't need to convince you that the mutual fund market is a big market, and the US mutual fund industry has been growing rapidly over time. And by the end of 2018, it manages nearly 18 trillion US dollars assets, and with more than half coming from the equity mutual funds. And with this growing market size, nowadays we have more than 8,000 mutual funds in total, and nearly 5,000 are equity mutual funds. So the good news is that we have a great variety of financial products to choose from, while an unintended consequence is that nowadays selecting mutual funds is at least as complicated as a direct investment in the stock market. So another unique feature for the mutual fund investment is that the retail investors hold 89% of the US mutual fund net assets. And we have an extensive literature showing that the average risk-adjusted fund returns and style-adjusted fund returns are often negative on after-fee basis. So basically, most of the fund managers, they may not have enough skill or they may not have enough incentive to create value for the retail investors and to benefit the retail investors. So in reality, we have a huge number of mutual funds, but it's actually not a trivial task for the individual investors to identify a very small subset of the skilled managers and to optimize their capital allocation. So prior literature also suggests that the individual investors, they're in general quite unsophisticated in mutual fund investment. So they time the market poorly, they favor those funds that attract their attention through advertising and media coverage, and they favor those funds with lottery-like features or holding lottery stocks. So since most of the mutual fund investors are unsophisticated retail investors, and naturally there is a high demand for professional investment recommendations. So currently, individual investors, they heavily rely on the Morningstar star ratings and they chase recent performance. So the star rating is mathematically derived and purely based on the historical performance. So Morningstar basically calculates a weighted average of the historical performance, and then they rank funds within each peer group based on this historical performance. So if you are in the top 10%, you receive a 5-star rating. And if you are in the bottom 10%, you get a 1-star rating, and it follows a distribution like this. So the star rating here is backward looking, purely based on the historical performance. But we also know that among mutual funds, there is little persistence of good performance, meaning that past performance doesn't represent future performance. So even Morningstar concludes that the star rating may not be so useful in predicting future performance and guiding the investment decisions. So to address this issue, Morningstar actually launched a new product, and this is the analyst ratings in November 2011. So unlike the star rating, which is backward looking, the analyst rating is forward looking. So it reflects Morningstar's conviction in funds' ability to outperform its peer group and relevant benchmark on a risk-adjusted basis. So to avoid any conflict of interest, Morningstar do not charge the fund companies to be rated. And the fund companies also don't commission the ratings, so it's purely independent rating. And it's rated on a 5-tier scale. So the top rated funds will get a gold rating and followed by silver and bronze. And all these are recommended funds. And then we have a neutral group and a negative rating. So the analyst rating is updated up to 4 times a year on a regular schedule. And Morningstar analysts rate funds based on the 5 key areas. So including the people, the process, the parent, performance, and price. as well as the interactions between those key areas. So as you probably expect to see, the analyst rating and the star rating are not highly correlated because the analyst rating is forward-looking, but the star rating is backward-looking. So the correlation in our sample is 0.41. Another thing I want to mention is that the Morningstar is a data provider. So it commercializes its fund research by including the rating in various products and services it provides to the investors. So they do have incentive to provide accurate ratings because it's the end users, the investors, who are paying for this rating service. So here's an example. If you search for a fund on the Morningstar website, and this is pretty much you see, and here this is the star rating. And next to it, we have the analyst rating. And you also see the rating on each of the 5 key areas they look into. And for those 5 key areas, it's based on a 3-tier scale, positive, neutral, and negative. So in addition to this rating, the Morningstar analyst will also write a report to justify the rating decision. So the report has a summary section and followed by the detailed discussions in each of the 5 key areas. And later we're going to do some textual analysis to identify the tones in those analyst reports. So in our sample, we have 240 unique analysts, and each analyst covers 27 mutual funds on average. And Morningstar has been improving and increasing their analyst coverage over time. But the number of funds covered by analysts is still limited by the size of the Morningstar analyst team. So by the end of 2018, they only cover less than 30% of the equity mutual funds. So which also means that the majority of the funds do not have a forward-looking rating as we probably hope for. So to expand the number of covered funds, Morningstar actually developed a machine learning model. So they use the decision-making processes of the analyst, and the analyst passed the rating decisions and the data used to support those decisions. So Morningstar basically trained a machine learning algorithm to replicate the analyst ratings. And then it applies this model to the uncovered funds and to generate the quantitative rating. Okay, so this is the new product introduced in June 2017. So now, so for all the funds, we have a forward-looking rating. It's either provided by a human analyst or it's generated from this machine learning algorithm. And the quantitative rating is similar to the analyst rating because it's also forward-looking, it's also independent, it's rated on the same 5-tier scale and from those 5 key areas. And the purpose is to closely replicate the analyst's output without regard for the analyst's thought process. And the machine learning model will only generate a rating, and it doesn't generate any analyst report, at least during our sample period. So the layout for this quantitative rating is very similar to the analyst rating. So this is also from the Morningstar website. And the only difference is that now you have a superscript Q, indicating that this is a quantitative rating from the machine learning algorithm, not from a human analyst. So another thing I want to mention is that the star rating is publicly available for all the investors. And for the analyst rating and quantitative rating, they're only available to the premium users. And the subscription fee is $199 per year. And we'll come back to this point later. So the snapshots I showed you before are after logging. Okay, so if you are not the member and then before logging, this is what you will see. So you can see the star rating and you know that the fund is covered by an analyst, but you don't know what exactly is the analyst rating. You don't know what's the rating for those 5 areas. And for the analyst report, you can only see the title and maybe the first line of the report. So if you want to know more, and if you click this like plus sign, and it will ask you to log in or ask you to subscribe. So I hope now I have set the stage and we are ready to talk about the research questions. So although the quantitative rating aims to closely replicate the analyst rating, and they can be quite different in each step of the rating process. So even before the rating started, and the analyst coverage is clearly not random. So the analyst might selectively cover the most popular funds with higher potential to attract more investors. And they might also cover those easy to rate funds with more transparent information with longer track record. And the rest of the funds are rated by the machine learning algorithm. And if you think that the analyst covered funds could be very different from the machine covered funds, and this could also lead to the difference in the predictive power of those ratings. And during the rating process, the human analyst could rely on different set of information comparing with the machine learning algorithm, and they could process the information differently as well. So for example, in addition to the hard information, the analyst will conduct interviews with the portfolio managers and the key executives in the fund company to collect additional soft information. But the machine learning algorithm only relies on the hard information. And on the other hand, the human analyst could face cognitive constraints, such as the limited attention, such as different behavioral biases we are all familiar with. But for the machine learning algorithm, it actually has the advantage to accommodate a high dimensional predictor set and to detect those complex patterns and even the hidden relationships in the data. And in terms of the output, the analyst will provide both the rating and the analyst report to justify the rating decision. So the research report could contain additional information. Those are the more qualitative information beyond the rating per se. And for the quantitative rating, you don't get those research reports. So with all these pros and cons in mind, and some would suggest that the analyst rating could outperform the quantitative rating in identifying those superior funds. And others might suggest that the machine can actually beat human in this context. So those are the research questions we will explore in this paper. So first, we are interested in, can analyst ratings and quantitative ratings identify those outperforming funds as they claim to do so? And is there any difference between these two ratings, and why? And what causes this difference? So previously, we talked about several potential channels, and we are going to look deeper into it later. And if those ratings predict performance, and why do they predict performance? So what's the information content here? So are they relying on the publicly available information, or this is due to the private soft information? And we're also going to separately look at the analyst ratings versus the analyst report. So finally, we are interested in, do mutual fund investors react to various ratings? And here we are going to separately look at the institutional investors versus the individual investors. So the data comes from the standard sources, and we focus on US actively managed equity mutual funds from 2011 to 2018, because 2011 is when the analyst rating actually started. So our sample has more than 3,000 unique funds, and about 1/3 of them are rated by analysts at least once in our sample. So here's the summary statistics, and basically to show that the analyst covered funds are indeed quite different from those non-covered funds. And analysts tend to cover the larger funds, the older funds. Funds charge lower fees and have lower turnover, and they have relatively better past performance in terms of star ratings and style adjusted returns. So analysts, they do tend to cover those popular funds that with higher potential to attract investors' interest. So here are the empirical results. So we first sort all the funds to 5 groups based on their analyst rating or quantitative rating. And the blue bar here represents the analyst rating, and orange bar represents the quantitative rating. And if this is a dashed line, it means that it's not statistically significant at the 5% level. And here we report the out of sample performance in terms of the monthly style adjusted returns. So you can see that the gold-rated funds recommended by analysts, they tend to outperform the benchmark by 1.46% per year. But if you look at quantitative rating, they actually fail to identify those outperforming funds. So even though the quantitative rating aims to closely replicate the analyst rating, and they are actually quite different. So a gold-rated funds recommended by human analysts clearly is different from a gold-rated funds recommended by this machine learning algorithm. And now the question is, what causes the difference, right? Why we see those different predictive qualities? So going back to the possible like channels we discussed before. And since we find that the analyst rating outperforms the quantitative rating in identifying those superior funds, so this is more consistent with the first two hypotheses. And because here we only look at the rating, and we'll come back to the last point about the research report in later analysis. So in order to differentiate between these two hypotheses, it's critical to have both analyst and the machine learning algorithm to rate the same set of mutual funds to have a fair comparison. And empirically, this is actually challenging because in Morningstar, a fund is either rated by a human analyst or by the machine learning algorithm. So what we do is to replicate the Morningstar methodology based on the random forest, and we reconstructed the quantitative ratings for all the funds. Okay, so now for the analyst covered funds, we have the analyst rating from Morningstar. We also have our self-constructed quantitative rating, and we call it predicted analyst rating. So now we can look at basically compare the performance of man and the machine for the same set of mutual funds. And if the analyst rating outperforms due to the information advantage they have, and we expect to see that the analyst rating continues to outperform our predicted rating in the same set of mutual funds. But if this is due to selective coverage, and then we expect to see that our predicted rating can identify those outperforming funds among the analyst covered sample because of this selection effect. But our predicted rating won't work for the non-covered sample. So here, let's first focus on the analyst covered funds. And so this is the same set of mutual funds, and we are comparing the performance of man versus machine. Okay, so you can see that both ratings actually identify those outperforming funds, and machine learning actually matches the analyst performance in the subset of analyst covered funds, and suggesting that the information advantage is not likely to be the main driving force for the different predictive qualities we observe between man and the machine. And in fact, our self-constructed predicted rating actually slightly outperforms the real analyst rating in this subsample. So now we can also look at the predicted analyst rating across different sets of subsamples. One is the analyst covered sample, another is non-covered funds. And we can see that this machine learning predicted rating only work for the analyst covered sample. Okay, so so here the evidence suggests that the analyst rating outperforms the quantitative rating mainly through the selective coverage channel instead of the information advantage. So the main takeaway for the investor is that at least they shouldn't treat these two ratings as equivalent substitutes, and because indeed they're actually quite different. So here we follow the Morningstar methodology. And but one caveat is that the machine learning algorithm is trained on the analyst covered funds and based on the past analyst ratings. So if you think that the analyst covered funds and non-covered funds will have very different data generating process, and then the training sample we use may not be sufficient to generate robust estimates for the non-covered funds. Okay, so our findings shouldn't be interpreted as men are better than machine, or we shouldn't use machine learning to provide financial advice. And our findings actually raise a few questions about the current implementation of the Morningstar quantitative rating. And there are actually a few directions to take if they want to further enhance the rating quality. So for example, Morningstar could at least temporarily randomize the analyst coverage, so we can build up a more representative training sample. Or we can set an alternative objective function to predict the fund performance instead of to predict the analyst rating. Because in the end, we want to identify those outperforming funds, right? So we can use the machine learning algorithm to directly predict the mutual fund performance. And if we want to do that, we can train the algorithm in the full sample, and we can bypass this analyst coverage issue. And we can just assign ratings based on our predicted performance. So overall, we find that analyst rating is actually a very useful indicator, and it's easy to follow. So if an investor currently follows the 5-star rating, and they can easily switch to the gold rating by human analyst, and then they can nearly double their performance after adjusting for the benchmark returns. And we get similar results in net of fee returns and gross of fee returns, suggesting that the analysts, they do identify more skilled managers and not just those funds charge lower fees. And another advantage is that if you follow the analyst rating, on average, there are 67 gold-rated funds every month, comparing with 200 5-star funds every month. Okay, so this could be a valuable advantage in practice because investors have limited attention, they have limited information processing capacity. But of course, we know that the analyst rating doesn't come for free, right? So the benefit is that you can improve your performance, your annual performance from 46 basis points to 91 basis points. The cost is $199 subscription fee per year. And this gives us a break-even portfolio size of around 44,000 US dollars. And because most of the households invest in mutual funds through their pension plan, and I would think that this is quite a modest amount. So now we know that the analyst rating predicts performance if we use it as an indicator, right? And then the question is, so why does it predict performance? And what's the information content? So now we move from the portfolio analysis to a multivariate regression, and we control for a list of fund characteristics that are known to predict future performance. And once we do that, you can see that the analyst rating no longer predicts the future performance. So the analyst rating actually consolidates those publicly available information to a user-friendly indicator. And this is also consistent with our prior finding that the machine learning algorithm actually matches up with the analyst performance. But this is still valuable for the investors because retail investors wouldn't run a similar predictive regressions as what we do here. And now we move to the analyst report. And you can see that the positive tones in the analyst report contains additional information beyond the analyst rating and beyond those known fund characteristics. So the Morningstar analysts, they do have some private information. They do have soft information. It's just not reflected in the analyst rating, and it's more incorporated in the analyst report. And the return predictability is actually further enhanced if the analyst report and the rating actually provide conflicting signals. So if this is a negative rated funds but have more positive tones, and they are going to outperform in the next period. On the other hand, if you are gold rated funds but you have more negative tones, you are going to underperform. And to better understand the economic magnitude, we also do a two-way sort based on the analyst rating and the tones in the analyst report. So let's focus on the gold rated funds, and conditional on a gold rating, whether you have low or high positive tone doesn't make a difference because the return spread here is insignificant. And what really matters is the negative tones for those gold rated funds. So if you have low negative tone, you are going to significantly outperform those with high negative tones. And from the investor's perspective, you should really focus on the gold rated funds, but with less negative tones. And they outperform the benchmark by 1.87% per year. And again, it doubles the performance from an average gold-rated funds. So we show that the analyst report contains additional soft information that augments the analyst rating, which is largely based on the known fund characteristics. And this leads us to think that a man plus machine model could actually be more productive and effective because we can use the machine learning to process those hard information, and analysts can really focus on collecting and analyzing the private and soft information. So finally, we are interested in whether investors react to those different ratings. So we first confirm the findings in existing literature that the individual investors, they strongly react to the star rating and to the recent performance. And once you control for the star rating, the analyst rating is no longer significant. But we still find some statistically significant results for quantitative rating. But if you compare the economic magnitude, the magnitude for quantitative rating is only about 1/5 of the star rating. So the star rating still play a predominant role in investors' decision-making process. And if we further dig into different investor types, and we can see that the institutional investors, they jointly use the analyst rating and analyst report, and particularly they exploit those conflicting signals as we documented before. So those institutional investors, they do withdraw from those gold-rated funds with more negative tones, but this is clearly not the case for the retail investors. So in our main analysis, we focused on the tones in the full report. And the full report is usually several pages long. And a retail investor may not go through the whole document. So here we also look at the tones in the summary section, which is like an abstract for the analyst report, and also in the title. So in terms of the return predictability, it really comes from the full report. So you need to read through the whole document to get an idea about what's the future performance. But if you look at investor reaction, they actually strongly react to the tones in the summary section and also in the title. So this is consistent with the idea that retail investors, they respond more to the information that attract their attention. But clearly there is a misallocation problem because the information they pay attention to is not that informative about the future performance. So we conduct a list of robustness tests, and I'm not going to talk about them for the interest of time. So overall, we find that the Morningstar analyst rating improves the investment outcome, and especially when you jointly use the analyst rating and analyst report. But this is not the case for the quantitative rating, and mostly due to the selection of analyst coverage and some caveat in the current implementation of this quantitative rating provided by Morningstar. So the return predictability of analyst rating comes from those observable fund characteristics, but the tone in analyst reports contain additional soft private information. So leading us to think that a man plus machine model could be more effective and productive. So despite the analyst rating provides useful information about future performance, and this is easy to follow, individual investors still chase the star rating, quantitative rating, and the recent performance. So that's all I have, and I look forward to Richard's comments.
Okay, thank you very much. Thanks for the presentation, Richard. You have 20 minutes.
Yeah. Okay, well, thanks for inviting me to discuss this paper. Happy to be giving a discussion for ABFER. Yeah, I'll just go through my discussion. I'll start with a brief overview of the paper, sort of the stuff I liked, and then sort of go into the comments for the rest of the time. This is sort of just my interpretation of the story, which I think fit pretty well with how C was presenting this. Right, so starting off, just we have a couple different newer types of ratings, right? Which one's better, right? So do you want the analyst to be rating, or is the machine learning algorithm equal, better, worse, right? In their writing, they say the human rating seems to be better, at least at picking out the top mutual funds. Then they ask a bit of why is the analyst better at this, right? And then there's two different stories. One is selection, right? So the analysts just select the funds that happen to do better and don't leave any of the better funds for the algorithm to pick from. And the other option is that there's just more information gathering by these analysts. And so they're using information the algorithm doesn't have access to. The results generally confirm their selection story, right? So it seems like if you were to say use an algorithm to replicate what the machine learning part does, but on the analyst sample, it works just as well. So it's probably a selection mechanism here. Information story is sort of, some evidence here, some evidence there, but a little less convincing. And they look at sort of who's using analyst reports and shows that there's some individual investment uses, mostly for the title and summary part of it, whereas the institutional investment part or the returns part tend to come from the full document. Now, I think some of the highlights of the paper, right? So one, so conditional on it being true that human raters are better than the algorithm due to a selection mechanism, I think that's an interesting result. So I think anything that's really digging into what exactly the raters are doing and how they're picking the funds they choose to rate is fairly interesting, right? And so saying that, it seems like the raters are actually quite good at picking the sort of the more interesting mutual funds, right? That in itself is an interesting result because it's saying that, with one part, it means that these guys actually have some predictive ability, right? And that they're able to actually pick out the better funds. But it's also just interesting to say that this is where the result's coming from. Second, I think that comparing human ratings versus machine learning rating that's actually in use is interesting, right? So a lot of papers are using a hypothetical benchmark or saying if we use this machine learning algorithm, we can get slightly better predictive performance, right? There's a lot of papers like that. This is not that type of paper, right? They're actually saying, well, here Morningstar came up with their own, right? So Morningstar is the analyst, Morningstar is the algorithm. Both of them are publicly available in quotes, right? If you pay 199 bucks. And yeah, so consequently, this is actually in use, right? It's in production. And so like on one side, if you want to point out shortcomings of machine learning method, this is pretty much the condition you need, right? Because if you just say, hey, we made a random forest algorithm and look, it doesn't work as well as whatever analysts are doing, people always say, well, maybe your algorithm's wrong, right? But if it's something Morningstar did, it doesn't really matter if your algorithm's wrong or not. It's Morningstar's fault and maybe they need to fix it, right? And so there's still benefit there. That being said, right, this does not need to show the benefits of machine learning, right? If you can say, hey, I can build an algorithm that beats a Morningstar analyst, then either way you can beat it. And number 3 here, right, the test showing differential impact of full document versus the summary and title parts of the analyst report. I think that's interesting, right? This fits with a lot of past results, right, about how, say, institutional investors are perhaps more sophisticated than other investors, right? And also just the sort of the inattention of investors at large, right? So they look at the title and react, whereas the full institutional investor, or the institutional investor, looks at the full thing, right? That's interesting. It could also be just a friction story, right? So perhaps it's easier to get the title than it is to get the full document. But regardless, it fits with a lot of results in the past, and it's a sort of a nice result. Now here is sort of my interpretations conditional on the results of the paper, right? So I'd say in terms of the first link, though, we're looking at, say, are humans better than the algorithms? Say, not really. The results are not very convincing from my perspective, and I'll get into a bit about why later. So I don't think that really matters, right? It seems like the analysts aren't very good. The algorithm's not very good. Sort of none of them are that good at this. And then when we go into the selection versus information, selection part's still fine, right? Information part, I don't see it as testing that channel. I'll get into why as well. I do think it shows there's a possibility of analysts having more useful information, but it's not very direct. It's sort of a very indirect way of looking at this. And then the last part that I highlighted was a third point of the last slide about the sort of the differential use of information. I think that's interesting. It doesn't tie to any of the research questions in the paper, though, as far as I see. So I think it's an interesting result, but it needs to be positioned a bit more clearly. So let me get to my main comments, right? So first is sort of under the umbrella of what's optimal for an investor in a mutual fund, right? So the univariate result they present and sort of lean the most on is essentially what does the gold rating from each of these classifications indicate, right? In terms of style adjusted returns, 1 month out or 1 year ahead, right? And say analyst ratings, yeah, well, it's better than nothing, right? Statistically significant than 0. Quantitative rating, not different from 0. Star rating, actually, if you go to the appendix, that's also better than, or statistically significantly different from 0, right? And so you say if your goal is just to get the highest average return based on just a rating, you could use analyst rating or star rating, and they're probably not statistically different. There's no test in the paper, but it seems unlikely those would be different. And so don't use the quantitative rating, but either the others might get you there if your goal is simply to throw a dart at the board and hopefully get the highest return. Now, that may not be what exactly a mutual fund investor is looking to do, right? So if you think about like these people who are doing, say, retirement savings, right? A lot of people invest in 1, 2, 3 funds, right? And so their goal, so there's that, right? They're also often not risk neutral in this case, right? So if it's a retirement investment, you're fairly risk averse typically, right? Meaning their goal is to avoid the worst performance, right? And at least just sort of peg to the market, right? And so there, maybe the spread is a bit of a better measure, right? So the spread between, say, the top rating and the bottom rating, right? So how good are we at avoiding these worst funds? If we look at that, well, the analyst rating 1 month out is not useful, and the analyst rating 1 year out is marginally useful. The quantitative rating works, and the star rating works, right? If this is your sort of optimization function, you would say, okay, I should use the star rating probably because the economic magnitude is much better, right? So actually ignore both these new ratings. The old rating from that goes back to the 1980s, that's actually the best option. Also, I want to highlight that Morningstar has actually done similar tests in an event study that they have, which I've linked here. I'll give a copy to the authors, where they show actually, so this is a little hard to see here, but the yellowish line here is the returns over 36 months to the quantitative rating for gold firms. And the bottom line is for the negative firms. They find like a 3% spread, whereas you guys find a 0.135% spread in 1 year. So they're finding a much bigger spread. I'm not really sure why. It's still, they're both doing event studies. The methodology seems pretty similar. So I think you should probably dig into a bit of what sort of how you're interpreting this versus how Morningstar is interpreting this. And you're both doing style adjusted returns. So it seems quite similar. Yet the results are starkly different. Okay. But then sort of the other punchline though is, let's say that you have more than just ratings, right? Let's say you have other data, like, just your typical mutual fund controls. All of a sudden, well, analyst ratings are useless. Quantitative ratings are useless. Star ratings are mostly useless. None of these ratings are useful, right? Just use your other data sets, run a linear regression, and you're better than anything else. And so then the question is, why use any of these ratings, right? If you're just like a, say, retail investor, just trying to optimize your portfolio for retirement, right? And you just want to pick that one mutual fund, and you're not that sophisticated, okay, that probably is reasonable to say that they're not going to run this analysis. If you're an institutional investor, you could pretty much just ignore everything Morningstar says in terms of the ratings, right? Because you would have all this data. And so it's not terribly clear what's the benefit of any of these ratings, right? So then the question is, okay, so why does this matter? Well, the way the paper's written, right? It's written about essentially about this being the sort of the thing that matters, right? As in, it has to be that the human's rating is better than the algorithmic rating, and that's why the paper is sort of as they frame it, that's why the paper is sort of important. So everything's essentially more motivated by this perceived superiority of Morningstar's analysts over their algorithmic rating. But the evidence of this seems pretty minor, and I'd say the analyst ratings themselves don't seem that useful. So I don't think this is the way to frame the paper, essentially. So the question then is, how would we reframe a paper to be consistent with these results that are actually presented by the paper? Right? There's two options here. One is try and come up with a story that doesn't require analyst ratings to be useful, right? I find that to be difficult. Like, I mean, I'm not a mutual fund person, so maybe there's an obvious answer here and I'm just missing it. Second is just to take a more agnostic and exploratory view and say, hey, Morningstar has 3 different ratings. Let's see which of them works, if any of them. Let's see what's the differences, maybe, and then you can still bring in the sample part, the sample selection from the analyst side, right? And I think that's quite fine, right? So I think it's a little harder to motivate from that perspective, but given that this is all produced by Morningstar, I think it still is an interesting setting. So I think it doesn't really matter necessarily that these results go against humans being better. It's just saying that, hey, look, Morningstar's, either their analysts aren't that great at predicting the market better than algorithms, at least in the current years, right? So note that all these tables I showed you are just the 2017 onward sample. So it's the same sample for the algorithm as well as the analyst, right? They seem pretty good in early years. They don't seem pretty good now. Then, of course, there's also the second question, which is why? And I'm not going to get into that. But there's sort of a weird case where the early years, like the 2011 to 2017 or so, the analysts were really good at picking the gold mutual funds, and then the performance drops. And I'm not sure what's going on there. Okay, main comment number 2, replicating Morningstar's machine learning method, right? So this is something they do in just a couple of tests. It's it's a lot of work for something that's not that central to the paper as it stands. So they essentially say that they're going to train random forest models. So there's at least 2 random forest models per pillar in the way that the Morningstar constructs this. And so they self-construct the same type of rating as Morningstar, but there's no description of how exactly this is done or what exactly you guys are doing. So I would like to see sort of a step-by-step, just step-by-step list of what steps you're actually taking, right? On the Morningstar is actually quite detailed in their own disclosures about this method, which is nice. But there's also another issue that they've changed the method over time, right? So there's a 2018 model and there's a 2020 model. So first things first is you have to say which model you're using. I suspect it's 2018 model. The 2020 model is better. And so that's also potentially a bit of a confound here, and that the 2020 model is a bit more refined. They've paid a bit more attention to some of these different behaviors that analyst has to make sure that the ratings really closely map to what the analyst does, right? So this is the 2020 methodology. They've got a random forest model trying to predict the positive side and negative side of each of the pillars. They've knocked these pillars that they follow down to 3. So they have people, process, and business, right? So they keep just 3 pillars. The other 2 pillars are kicked out. Then they're going to predict probability of being above average or high, predict probability of being low or below average, average those out. Then they have these set of 4 other things that they do to sort of normalize these ratings, make sure that they're consistent with how their analysts approach it. Right? So for instance, they're going to make sure that if you're doing a people pillar and you have the same people running multiple funds, make sure those scores are the same. They're going to weight it average across each of the funds to make sure they give the same scores to the same people. Right. And they're even, in fact, even if you have just say one manager that's the same and another manager is different, they'll weighted average across that as well. So it's actually quite nice. The second thing is they've added in this part where they're looking at medalist eligible first, just like their analysts do. So they're really trying to mimic very closely to what the analyst does. But the documentation is actually surprisingly thorough. They even tell you exactly what variables are in the model, right? So you can actually very closely mimic this if you wanted to. And the second question then is, how well does the replication work, right? So there's nothing really showing how well your replication of their method works. So are you closely mimicking what they've done, or you could simply just say rerun the quantitative part and then see, are your quantitative scores the same as their quantitative scores, right? And if you have a 90% accuracy, yeah, I mean, I'll give you a pass there, right? If you have 50% accuracy, then it's a bit questionable. So I think that definitely needs to be disclosed, right? You could also say a confused matrix between your scores and their scores. They've actually done some validation work as well. So again, in those documents that they've released, they've shown, for instance, that they work pretty well on their parent pillar, right? So they even show at the pillar level their accuracy. Parent side's good. People side, the positive model is not very good compared to the negative model. And same for process, right? So they're showing like there are some cracks in the model. So there's reason to believe it's not 100% perfect and won't do quite as well as the analysts. But it does do pretty well in some cases. Okay, last one. The human versus machine part, right? So this is another central part of the paper, right? I mean, it's in the title, right? So it's all a lot of the paper center on, is the human better than the machine or not? And sort of, since the results don't seem to indicate so strongly one way or the other, we could ask, why won't we care? Well, there's a couple of reasons, right? So one is you could say that maybe there's some other reasons in these tests why it's not wholly convincing that there's not a big difference in performance, right? So there could be some other things going on, right? So for instance, this other information collection by analysts, that could be something important, right? The other thing is that, of course, the analyst rating is not the only output by the analyst, right? They actually have a full report. And so there's a lot of other stuff they produce. Maybe that stuff's useful, right? And so that's another part of the sort of one of their conclusions is that, we could take this sort of hybrid approach, let the machine just do the rating, let the analyst do the analysis and release the report, and maybe that's optimal, right? And so they're using Tone to try and tease this out. And I think that is actually, this sort of focus is something that's good to look at. I'll also just caution, right, throughout all this discussion, remember that the machine learning method is only trying to replicate what the analyst does. They're not trying to be optimal, right? That means if the analysts have problems, they want to replicate those problems too, right? So to some extent, the machine learning method should never be able to beat the analyst because it's not supposed to, right? It's only supposed to try and pin to the analyst and never actually sort of go beyond what they do. Now, for the Tone test, right, you can ask, what is Tone actually measuring, right? The argument in the papers, it's measuring the soft information collection of analysts. And they're trying to predict or use this to determine the dependent variables, such a usefulness of this information. Usefulness is measured by style adjusted return, which seems reasonable. But Tone as a measure of soft information collection seems quite a stretch, right? It's really soft information generation, right? So it's about the output, not the input, right? And so you're trying to, I mean, of course, the problem is the input's latent, right? We can't observe that in the US context, right? There is a paper that has a very nice measure, right? This paper actually by Chung here at SMU, right? So Chung, Du, Wang, and Wang, 2016 RAS. In China, you can actually observe when there's site visits by Chinese analysts, right? So you can actually see the information generation in a data set. That's quite nice. Unfortunately, US context doesn't have that. And And so we're kind of sort of left in the dark about what the actual collection is, right? That's a problem, right? So we're trying to tease out latent information. That's tough, right? The other problem is, of course, where the tone comes from is also latent. So you have essentially 2 layers of latency under the hood, and it's very indirect, right? I think the best we can say is just this is soft information generation. I will note there's also perhaps better proxies of that as well. Right? There's a latent racial allocation based proxy. Michael Shen, the Shen Jiang Kong working paper, right? So I think Michael Shen's on the call here. So you could always ask about that. And so I think at the end of the day, we can't really complain that the results are consistent with machine learning algorithms, maybe being able to exploit publicly available information, but saying humans have the advantage of collecting and incorporating soft information. There's no test that shows this, right? It's true that, of course, humans can do this. It's also true that a computer could do that if you wanted to program it, right? It's just harder. Let's have a couple more slides to go through here. So there are a couple ways I think you could test this. They're both a bit of a pain, but I'll show you guys a couple ways I think that could work, right? So first is we could actually try and build a machine learning model to predict the tone of the analyst reports, right? So actually try and put the analyst and the machine on equal footing, right? And then you could see, is there an incrementally useful amount of information in the analyst tone as compared to the predicted tone from the machine learning algorithm? Now here, right, the pro is you could convincingly show one way or the other whether or not the tone is quantitatively driven, right? If you're going to rule out it's quantitatively driven, I think it's easier to buy that the analyst has some qualitative information that they're leveraging. It also puts the analyst and machine on equal footing, right? Which is important in terms of testing this. It also, of course, then brings in this human versus machine motivation, right? Right now, these tests kind of throw out the machine and just say, let's see what the human does, and ignores the whole sort of overarching sort of theme of the paper. So it sort of brings the machine back into the story, which would be nice. The problem is this is very difficult to do well, right? So trying to actually model the analyst's tone generation process from a machine learning perspective needs to be custom made. It needs to be very precise, needs to be fine tuned, and you need to be able to convince readers that you're doing a fair job, right? So that's tricky, but if you could do it, it works very well. The second option is easier to do, right? So here we could try and isolate the impact of tone in terms of how analysts are using this in the rating categorization, right? So in other words, what you want to look at are those edge cases where the analyst is like, do I give it a gold or a silver, right? And if you could isolate that there's an effect of tone on these decisions, and then show that these decisions of going, yes, I'll go down to silver, or nah, I'll just barely put it in gold. If you can show that that has implications for style adjusted return prediction, then you can also show that, right? So if the tone has some impact on the analyst rating, then it must have been also collected for the purpose of their own rating process, right? And then you can argue it's not just generation, but it's also used in their process. The problem is something like this, you probably need structural equation modeling to actually do it convincingly. And so econometrically, this is also painful, but it's easier in terms of it's just pure econometrics. You don't need to have a nice machine learning model and convince people it's fair. And lastly, I think there's some other nice results, right? So as I mentioned before, I think I quite like the results about the difference in how sentiment or tone is reacted to in terms of the title and summary versus the sort of the full document. And so I think that's an interesting result. It doesn't really tie back to the story very well, right? So it's sort of, again, it goes back to sort of think about how to position the paper and the writing. But it's a neat result. Now, the one thing, right? So there's some talk about this being irrational investor behavior and whatnot. I don't think that's something you want to really get into. There's no benefit of calling it irrational, right? So the question then becomes, is it rational for an investor to pay $199 to subscribe to Morningstar in order to get this information? Maybe, maybe not, right? So it really depends. Like, I mean, as you showed, like you need 44,000 in a portfolio. For some people, yeah, then 199 is a drop in the bucket. For some people, it's still not that easy, right? Especially again, you're also taking a risk neutral perspective. You're taking a risk averse perspective. Maybe 199 is actually not worth it. I don't think you gain anything by calling it irrational. But I do think it's an interesting result. A bunch of other comments I'll give them about the say tables, sample selection, and writing, but I'll skip those for now. Going forward, I think there's sort of 4 main themes, right? So one, I think the writing needs to be made to be a bit more consistent with the results, right? So again, either a story that doesn't require analyst ratings to be better, or something that's more exploratory. The replication part needs to be more transparent and could be used more productively, right? It's not very well leveraged in the paper. Just sort of it's there and then it sort of disappears, but it could be used sort of throughout. And then I think again, thinking about this frame of human versus machine, whether that's the focal point or maybe it's not the focal point, and it's something that just sort of comes up as part of a paper that's more focused on analyst behavior, right? So there's sort of a couple ways the paper could go. Yeah, and then separately, right? If information generation by analysts is supposed to be the focal point, I think a more direct approach is going to be needed. So thanks. Hope these comments are useful, and yeah, happy to, of course, talk with you later if you have any other questions.
Okay, thank you, Richard. Thank you, Richard, for your comprehensive discussion. Maybe Chen Shi can respond a bit.
Thanks a lot, Richard, for the very thoughtful and detailed discussion. And I'll just quickly clarify a few points, and I would like to take more questions from the audience. So first, so we focus on the long side of the investment. So we are not looking at the return spread, and because you can't really short sell a mutual funds, right? So you can avoid a bad funds. You can try to if you already invested, you can withdraw from it, but you can't really short sell a mutual fund. And that's why the spread return may not be that useful. And another reason is that because we know the analysts try to cover those better funds. And that's why if you look at the return spread, the star rating will actually give you a better performance because star rating cover all the funds, right? Analyst is more like a tilted sample towards those better funds. And I would like to clarify the difference between our result and the Morningstar result you show. And they do show that when they launch the quantitative rating, they show that the quantitative rating actually works, right? And this is something they need to justify when they launch a product. But their result is based on a back testing period. And this is the historical, so the one we, so from the methodology we follow, and that this is, they do list a back testing period. But what we track is the out of sample result after they launch the product. So it's not their in sample results. So and for investors, and you mentioned that what's the useful thing to do, right? So I think from our our starting point is that the investors will use those ratings as an indicator to make investment, and they don't do predictive regressions as what we do, and they don't collect information on fund characteristics, and otherwise they don't need the ratings probably. And in our sample, we actually find that analyst rating is actually doing a better job in the post 2017 period. So if you look at the gold rated funds, not the long short spread. And we follow the 2018 method because this is when our sample stops, and we train our model based on the 5 pillars. And we also do adjustments, follow the Morningstar methodology. So if they are from the same family, if this is from the same team, and then we do those adjustments as they stated. And I think we are not really trying to differentiate whether this is information collection or information generation, and we are just trying to point out that the Morningstar analyst seems to bring additional information not captured by the observable fund characteristics. And I guess that's all I have now, and I'm willing to take more questions.
Okay, we have a question from Professor Bhattacharya from Hong Kong University. The question is about Burke and Green. That's my favorite finance theory paper. So the question is, if a forward-looking gold rating is great and everyone believes it, funds will flow to the fund, and what will the fund do with that cash? Invest? Then the return will go down, right? It's diminishing return to scale. Then they are no longer that great. So accuracy of forecasts are destroyed by their credibility. Is this a paradox? I think this is a well-known result. So
I think so. Thanks for the question. And so in this case, so we do see that. So I think I can answer it in 2 ways. And one is that all the funds, they want to generate they want to have large assets under management, right? The fund objective is to maximize the revenue, which is a function of the fee and the size. So the good funds is rewarded by large assets under management, as Burke and Green would say. And then the question is, when we try to understand the managerial skill versus the welfare implication for the investors, actually different. So for the investors, they do care about the returns, but if we want to actually assess the managerial skill, we look at the value added, right? So there are new measures to be proposed, and basically you do consider the size in when you assess the fund skill. So you look at the alpha they generate multiplied by the assets under management, and the whole idea is that it's more difficult to generate alpha if you have large assets under management. And but for investors, of course, so this is a dynamic process, right? So they can still withdraw from the fund if they are not happy with the performance. But in general, we do see that the good managers are rewarded with large assets under management. And on the other hand, another reason is that there is a convex performance sensitivity, right? So investors are very sensitive. People flood into a good funds, but when the funds is not doing well, and they may not withdraw immediately. So that's why this thing may not totally collapse.
So we still have 4 minutes for a final question. So okay, yeah, Bing, please go ahead.
Okay, can you hear me?
Yeah.
Yes.
Okay. So my question is, right now, of course, I have not read the most recent version of the paper very carefully, so take that into consideration in your response. So instead of kind of comparing analysts versus machines, now would that be more interesting by saying how machines can combine with humans to do a better job in capturing the information from both sources? Because I think in the paper, kind of you talk about the competitive advantages and disadvantages of machines versus humans, right?
Right.
So humans may be able to capture the soft information on a more timely basis, but the machines are more powerful than the human brain in analyzing the harder data. So as a result, in theory, kind of, if you can combine the analyst information with the machine generated information together, you may be able to do a much better job for investors in selecting, I would say, the very top funds for them to consider, right? So all you have to do is just recommend what are the better funds investor could consider by combining the strengths of both sides.
Yeah, so it's a very good point, and so I think a reasonable thing to do is you can use the analyst rating as one of or analyst report as one of the input variables to train the machine learning algorithm, and then we need to predict the fund return, right? So this is currently we are not doing that, and because in the paper we are trying to basically answer the question that is the analyst rating different or the same as quantitative rating. So we actually follow the Morningstar methodology. But if the question is how to combine the man and machine to provide better investment advice to the mutual fund investors, and this is definitely the way to go. And yeah.
Suqing has a question.
Yeah. I have a question. Very interesting paper. I actually understand from some other people who are also doing some related work. So I'm just wondering, because the Morningstar, what's the objective for that the Morningstar launched this quantitative machine learning techniques? So I'm guessing their objective, they provide this data is mainly to show that the machine learning techniques actually can, mimic human being. But I'm guessing that's not the main objective, right? What's your understanding of the reason they are doing this?
So Morningstar, basically they commercialize this product. So they add this like rating to many products and service they provide, and they charge investors. They charge end users the fees for it. So basically they're selling this like rating service to the investors. So as they claim, they try to help the investors, like especially the retail investors, make their investment decisions. And that's why you need to subscribe, right, to the like the
I understand. Yeah, I understand that. But so I'm guessing. My guess is that you know, because a human being, because given the limited capacity,
Right.
they can only, the analysts can cover only like based on your statistics roughly 30%.
Right.
Of the population. So using the machine that allows them to cover, you know, mimic analysts to cover other funds that are not covered by the human beings. So
yeah, and it's also cheaper, right? So it's like you can easily like produce those ratings, and so once you, because they have all the like input variables, the raw data, and then they can easily generate. Once they build up this algorithm, it's almost like costless. And but for analysts, it's going to be more costly. You need to hire those like analysts to do that. That's why the analysts tend to cover the better funds and would like attract more interest of the investors. And the machine learning is actually covering those like sort of the niche funds.
Yeah, but to that extent, that your research question that whether machine, you know, do better or worse than the human, isn't that the reason, that kind of the starting point where Morningstar start with all these initiatives?
So so we basically take what they have as given, right? So we are trying to understand what they provide. Does it really justify the job they claim they do? But from Morningstar's perspective, and I do think that they think they can sort of the machine, from Morningstar's perspective, from all the like interviews and talks they gave, they do think that the quantitative rating is like more or less equivalent to the analyst rating in terms of giving investment advices. And that's why they actually recommend investors to use the quantitative rating in a similar way as they use the analyst rating. And actually starting from like earlier this year, Morningstar also asked machines to write analyst reports now. So now you can actually even get those like analyst report written by the machine algorithms. So their starting point is they are the same, but this seems to be different from what we find, at least in the sample we have.
So did you talk with Morningstar, and what's the reaction?
So so not yet. So long story short, not yet. Yeah.
Okay, thank you.
Okay, I think we are running out of time. I hope to hang out with you for further, but we're really running out of time. So this is the end of today's session. I want to thank you all for participating and contributing to today to the ABFER conference. And unfortunately, we are not meeting in person. It could have been better if we can meet in person. So I hope that we will have a chance to meet you guys in person in Singapore. Okay, good luck with everybody. Good luck with all the papers. And we will keep in touch. Okay.
Thank you.
Thank you.
Thank you.
Thank you.